Welcome to Chapter 5 on Consumer Credit, dear students. Now, I beg your forgiveness. I apologize in advance because I take on the persona of a hellfire and damnation backwoods Southern Baptist preacher when it comes to credit, especially credit cards. And when I saw this quote, I thought, I gotta use it. It's a little raw, so again, I apologize. But this is from Elizabeth Gilbert, who said that borrowing money is like wetting your bed in the middle of the night. At first, all you feel is warmth and release, but very, very quickly comes the awful cold discomfort of reality. Yeah, I apologize, but seriously, folks, there are many of your fellow Americans who have been bitten by the consumer credit parasite, which then proceeds to start sucking your blood from you. So hopefully this will keep you from being one of them. Slide number 2. What is consumer credit? Well, credit is an arrangement to receive cash, goods, or services now and pay for them in the future. Consumer credit is the use of credit for personal needs. Now, this excludes home loans, home improvement loans, higher education loans, and of course, we're not even going to discuss borrowing money for investments and specifically real estate. So this is consumer credit. And I just love this. It is a major force in the American economy. Yeah, there's an entire army, several of them out there, doing their best to make sure you spend every single dime you earn and then even more. So they can charge you interest 20%, 25%, 199. There are 3 ways consumers can finance current purchases: take money from savings, use present earnings, or borrow against future income. And there are trade-offs involved in using credit: opportunity costs, danger. So, slide number 3. Now, don't get this one wrong on the exam, please. It's really bad for my self-esteem. Does consumer credit increase or decrease your purchasing power? Now, in the face-to-face class, we have these ABC cards, and people hold them up, and it's at the more, at the university, they have a little button you press, and it shows up on the screen. But we're not that rich. Does consumer credit increase your purchasing power? Does it decrease your purchasing power? Or does it have no effect on your purchasing power? Now, we'll get a little mixed bag. Very few people pick C, although sometimes they do. But a lot of people will pick A, and a lot of people will pick B. And then we ask them, okay, why do you think it increases your purchasing power? Because you get the stuff right away. Why do you think it decreases your purchasing power? Right, because it ain't free. The correct answer is B. It decreases your purchasing power because now you're using some of your disposable income to pay interest. And the credit card companies and the banks and the credit unions are extremely happy that you're doing so. They're smacking their lips. But as it pertains to your personal financial situation, no, it decreases your purchasing power. So again, you're not going to get this one wrong on the exam, please. Okay. Slide number 4. The problem with credit is that it's not free. The cost of credit. The finance charge is the total dollar amount you pay for the loan. Now, this includes interest and fees, such as any service charges or credit-related insurance that they do their best to tack onto your account. The annual percentage rate, APR, is the percentage cost of credit on a yearly basis. Do you remember APY from the previous chapter, an annual percentage yield? This is annual percentage rate. And this was mandated by the Congress many years ago, 1970s, such that you can now look at 2 different accounts, one saying they're going to charge you 14%, the other one saying they're going to charge you 18%, and you know that the one that's charging you 18% is charging you more. There used to be ways that they would sneak in extra fees so it looked like the 14% was a better deal, but it really wasn't. No, 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 no. Not anymore. An annual percentage rate provides the true rate of interest for comparison with other sources of credit. This rate lets you compare like with like when shopping for rates. The Truth in Lending Act. You see, when the demagogues and the Republicrats get together and play nice in the sandbox, they can do very important and useful things, such as the Truth in Lending Act, which requires creditors to provide you with accurate and complete credit cost terms and annual percentage rate. They must disclose the credit terms and information in a clear and conspicuous manner in a form you can keep, but often in a font you can't possibly read. And that's where they put all the information they do not want you to read. That's just what happens if you miss a single payment. Your interest rate goes up to 1,000%, and they come and take your house and your firstborn, and you'll be in debt to them for the rest of your life, which that will not be that long. But then they don't even care because you're going to work yourself to death trying to pay off. They don't care because they will have made enough money off of you to buy one or maybe even 2 yachts and a brand new gas barbecue and a trip around. My apologies. I told you I get crazy. I see people, friends, family members, strangers destroyed by credit cards and credit industry. And what can you do? What can you do? I'm doing the best I can. Calculating the cost of credit. Now, if you remember back in chapter 1, we talked about the simple interest calculation. And that's what we're going to do in this chapter. Okay, so there's a worksheet and there's some problems, and they're not that hard, folks. If you have any problems, you contact me. That's why we're here. And of course, don't forget the Academic Success Center, and you ask to talk to the either tutors for finance or the math tutors, and they'll say, "Oh, we can't do finance." And yes, you can. As soon as you show them the formula, they can help you. They'll say, "Oh yeah, we can help you." The dollar cost of borrowing on principal only and without compounding, which we learned compounding first in chapter 1, is interest equals principal times rate times time. Now the rate is in APR, an annual percentage rate. The time must also be expressed in years. So this is where it gets a little tricky. If they say days or year or months, you got to switch them. You got to convert them to years. So it gets a little tricky, not that hard. This is used for most installment loans. Now, credit cards have these funky different ways that they do things. The average daily balance method, most credit cards use this one. It uses a weighted average. Folks, their systems are so sophisticated. They keep track of the balance every day and their purchases and your payments. And so if you carry a balance, new purchases will be included in your average daily calculation going forward. So you want to pay off that credit card, and we'll talk about this later on, how to use a credit card, how to be part of the benevolent machine, how to get in the good graces of the system without having this life sucked out of you, your financial life sucked out of you. If you pay off the balance every month, which is what we're going to help you start doing, right? Start small, $50 a month or $30 a month. You use it to buy something and then pay it off right away. You get to take advantage of what's called the float. As soon as you incur a balance, as soon as you don't pay it off in full, that's when they get their hooks in you. Yeah. Now, there are a couple other ways that credit cards charge you, how they calculate it. And most use the first one that we saw on the previous slide. But on slide number 7, you see the adjusted balance method, which is the most favorable. And typically credit unions will do this. New purchases are not taken into account. All payments are deducted from your previous balance before the interest is added. It's not that common. Again, check your credit union, most likely to use it. The previous cost balance method is in between these two, the first one and the second one. And the 2-cycle average daily balance method was the worst one. And you don't see it that much anymore. We're looking at you, American Express. Yeah, they used this, but I don't think they use it anymore. So be careful. I'm not even sure about Disaster Card, what they do anymore. I should check. Now, if this stuff interests you, if you want to get in the industry, because the industry needs people, folks, and it's a lucrative industry, read this article here about all the different calculation methods that the credit card companies use. But you're not going to have to do that. All you're going to do in this chapter is principal times rate times time. Okay. Now, do you remember our $299 stereo? Mm-hmm. Well, it cost us almost 2 times more than $299 because of the taxes, depending on our marginal tax bracket. But what if we had purchased with a credit card and only paid the minimum payments at 19.9% APR and 2.2% minimum? The price just doubled again. It cost us twice as much if we purchased it on credit and only make the minimum payments. And since all of these are after-tax dollars, the true cost of the $299 stereo, for most people, not quite $1,200, but $900. Did you think about that when you walked into Worst Buy and bought that $299, whatever it was? Will you think about it next time? Yes, you will, which is why you won't be using your credit card. When to use personal credit. Now, here are 3 situations where it actually makes sense, although it's not without its dangers, and that's buying a home, which we'll discuss in detail in Chapter 7 because it is the biggest purchase that most people will ever make in their lifetime. Going to college or career-related education. Ooh, isn't that a bit of a bugaboo these days because people went into such big debt and now they're screaming and hollering and they can't get it erased through bankruptcy, as we'll see in the next presentation. Whereas businesses can go into debt and have it all erased. One of our ex-presidents did it 4 times. Another one did it twice. But it's still, you are investing in yourself. And that is, I think, the most important investment. And then improving your home. Many people say, "Oh, you go ahead and put in that wonderful kitchen, fix the kitchen. It's going to increase in value." Really, no, not really that much. But hey, it's a home first, and an investment second, in my humble opinion, as we'll discuss when we get to housing. When should you use consumer credit? Never. Oh, right. Okay, in case of an emergency. Ooh. Try our easy payment plan. 100% down, no monthly payments. Which is why one of our goal examples was saving up for that $2,000 home entertainment system. Because you don't have to worry about the payment. But they say if I pay it off, I can do it on credit. And if I pay it off in 12 months, they won't hit me with any interest. But what happens if you don't pay it off entirely within the 12 months, 18 months, whatever, how much time they give you? Right, they go back to the very first day and tack on all the interest they would have charged you. Outrageous, but totally legal. You signed the contract. What are the credit considerations we should take? Before you use credit for a major purchase, ask yourself some questions. Could I pay cash? Can I make a down payment? Layaway, it was called. They don't want to do it anymore. They want you to sign up for a credit card. But it used to be that J.C. Poopies and Montgomery Wards is gone. J.C. Poopies probably will be soon. You wanted that refrigerator. It was on sale. You went there. You didn't have the whole money. You put down $50 and paid $50 for the next 6 months or whatever and took it away. Yeah, they realized they weren't making any money that way, so they created their JCPenney credit card and Walmart credit card and Target credit card, and they get you with the interest. Do I want to use savings? Does it fit my goals and budget? Could I use the credit in some better way? Can I postpone the purchase? Postpone the purchase? What are the opportunity costs of postponing the purchase? In other words, if I need a new washing machine, if I don't buy it, I'm going to have to be going to the laundromat. Well, that's an opportunity cost, that time involved. But most importantly, what are the dollar and psychological cost of using credit for this purchase? What is it going to cost me, your money or your life, right, in terms of my financial life, which spills over into my real life? Now, there are some advantages, okay. You get to use the goods or services now, even when funds are low. Convenience. Well, sure, who likes to carry around a whole bunch of cash? They are safer than cash, and you can take advantage of the float time. Hang on a minute, we'll discuss this in a bit. Some people use their credit cards for everything. Why? They run their groceries through. They run their electronics bills. You know, their cable service, their telephone service. Why? Because they're able to get rebates, airline miles. Careful. If you've become a good little droogie and are part of the benevolent machine and pay off your credit card bill, use it like a debit card, this is a great thing. But oh boy, can those rebates and airline miles wind up costing you tremendous amount of money. It is important in this society to build a credit rating, and we're going to teach you how to do that in the next presentation without getting this blood sucked out of your life, out of your body. And then, of course, using for financial emergencies. It's important to have something to fall back on in a financial emergency. What are the disadvantages? Notice most of it's all red, right? And highlighted. Purchases are more expensive. Does it increase or decrease your purchasing power? Everyone should yell out, decrease. There's a temptation to overspend. Oh my goodness. What we ask people to do is, instead of using the credit card, which you normally would use, pay cash. Carry that cash with you. Take it out of your pocket and plunk it down on the table. And then ask yourself, how did it feel differently than when you just swiped that piece of plastic, huh? We want you to analyze your emotion. It ties up future income. Does it increase or decrease your purchasing power? It decreases your purchasing power. And you may be saying, why do you keep saying that? Because we want to knock it into your brain. We want you to understand that using credit is reducing your purchasing power. I like this one. Possible financial difficulties. Yeah. And then this, I don't agree with this too much. Potential loss of merchandise due to late payment or not payment. This is not typical with credit cards. They don't want the DVD player. Oh my goodness, am I dating myself? Or the new smart speaker that you bought with your credit card. Now, if it's a car or furniture or something else, maybe yeah, they're going to take it away from you. So, what are the types of credit? Slide 15. Well, there are two types: closed end and open end. Open end is also called a line of credit. Closed end credit are typically loans that are for a specific purchase: mortgages, automobiles, furniture, big ticket items. Whereas lines of credit or open-ended credit are mostly credit cards and revolving credit at various institutions. You use them as needed until the limit is reached, in which case, if you've been a good little droogie and been paying your bills on time, they'll increase your credit because they want to make more money off you. If you do not use the credit, or if you pay it in full every month, you don't pay any interest payments. Very cool. And we're also going to take a look at a home equity line of credit, which is similar to a credit card, but very different in that it's based on your home, but you use it as needed, and usually for big ticket items. You don't use it like a credit card. So finally, let's discuss credit cards in detail. And now, I didn't make this up. I wish I had, because this is a tremendous saying. The bubonic plague of personal finance. Jonathan Clements, a very good financial writer. Now, be careful. There are two other writers with the same name. So if you look for his writings, you might find some other writer. Be careful. Nearly 8 out of 10 American households carry one or more credit cards. And here's a number that I don't know if it's true. I have a hard time finding this data, but this is what's generally considered the truth. 1/3 pay off their balance every month. They use it like a debit card. They are called convenience users. The other 2/3 are borrowers. They're people who the credit card companies have their needle in their arm and they're sucking out their blood. Now, here's where they've turned the language on its head. The convenience users are called by the industry deadbeats. Now, many of you younger folks probably never heard that term deadbeat. A deadbeat is somebody who doesn't pay their debts. They've turned the language on its head. People who pay their debts now are deadbeats. Figure that out. Anyway, if you pay the credit card in full every month, which we hope you're going to do, and we're going to teach you in the next presentation about getting a secured credit card, so relax, you are going to be showered with love and attention by the benevolent machine, and your credit score is going to go high, and congratulations. But if you're one of the 2/3 who are borrowers, you're possibly going to be in a lot of trouble eventually that we'll discuss. And some of you probably have gone through this, and I apologize on behalf of the industry. It's just horrible the way the industry treats people. But they say, hey, nobody put a gun to their head. No, they're just bombarding you with 10,000 images every day to buy. And then when people get in trouble, they go, oh, it's so sad, but it's not our fault that we didn't make them do it. Slide 17. Debit cards and credit cards are not the same. The laws and regulations differ. On credit cards, there's a $50 limit. That's it. If there's fraud, all you're on the hook is for $50. And if they try to give you any guff, well, they're going to ask you to file a police report, which is fine. That's what you should do if it indeed was a crime. But in the case of debit cards, notice, there's a $50 limit if reported within 2 days. A $500 limit if reported within 6 months. And after 6 months, oh well. Now, most banks, credit unions, they're going to waive, W-A-I-V-E. They're going to forgive you of the above limits for the debit cards. But do you see why it's so important for you to reconcile your checking account, your bank account? Because there could be fraudulent usages of your debit card. Yeah, so there. For that reason, some people say, well, I'd rather use my credit card because then they can only get me for $50. Be careful. As long as you pay it in full every month, sure. Now, what is the cost of convenience? We said that credit cards are very convenient, and they are. I mean, no one's going to argue that point. But what is that cost of convenience? And this is from The Wealthy Barber. One of the students, Kathy, is the spendthrift. She has a very good salary, but she spends a lot, right? So she's trying to defend her spending. But aren't credit cards a good way to save money? As long as you pay the total amount each month, you are essentially getting a free loan. Plus, they are so convenient, said Kathy. Not so fast, said Roy. By taking advantage of the float, as it is called, you may save a few dollars a year. But the pennies you save each year are swamped by the hundreds or even thousands of dollars you spend because of the very same convenience you speak so highly of. How many times have you rationalized the purchase of items simply because you told yourself you wouldn't have to pay for it until next month? And then when the bill came the next month, you ask yourself, how did I spend $500? The cost of convenience is very high. And we're going to have an assignment in chapter 6 called the cost of convenience. So be careful. Yes, they're convenient. Yes, they're safer. And yes, you can get airline miles and rebates and the like, but that cost can be swamped by overspending and then not being able to, or having to pay the interest payments, or not being able to pay the interest payments. So, true confessions. This is for the face-to-face class when we're all working together. How many credit cards do you have? Hey, zilch, zero, zilch, not a no way. They're not going to get their hooks in me. Well, if you're one of those people, we're going to do our best to convince you it's a good idea to get a credit card. What are you talking about? You just spent the last half hour screaming at me for not getting one. No, that's not what I said. I said I'm trying to keep you from being caught in the cycle of paying the minimum payment and the like. we're going to teach you that getting a credit card and then using it to buy little, maybe gas or whatever every month, and then paying it off at the end of the month is going to help you build your credit rating quickly and be in the good graces of the benevolent machine. B, only one, I swear it. I only use it to buy gas. So that's, or maybe pay your cell phone payment or whatever. That's what we want. We want you, if you don't have any, we want you to do B. Okay, C, I have two. I use one to pay the other one off. D, more than two, and I lost count a long time ago. Oh my goodness, we hope you're not in that situation. And if you are, that's a good idea to get that cash flow statement out, get those goal settings from chapter 1, work to pay down the highest credit card interest, or maybe talk to the credit card company about lowering the interest rate and work, set up goals to get you down to 1. True confessions. How much do you owe? Nothing. I'm serious. I don't own a cent. I love A. That's the best. And if you do use it as a debit card, yes, you owe some money, but you're going to pay it off at the end of the month. My son, I guess I created a monster a little bit. He uses his credit card and then he goes into the website and pays it off immediately. I said, Joseph, you can wait until the end of the month. He goes, no. B, less than 1,000. Between 1,000 and 5,000 and more than 5,000, folks, the average household has more than $5,000 in credit card debt. Yikes. That's a lot of money, folks. That's a lot of interest. Well, that's why when you grow up, you want to be a bank, right? How do you know a bank is making money? Their doors are open. So if you can't be a bank, at least get a job at a bank. The industry needs you. Anyway, here is my advice for what it's worth. Use your credit card like a debit card. If you cannot pay off the balance at the end of the month, don't use it. It's that simple. But I need as an emergency. Oh, all right. If you find that you abuse your credit card, if you find that you're always using it when you shouldn't, cut the damn thing up. Now, notice I used the singular instead of the plural. Do not have more than one credit card. Okay. Maybe you have a business. You use one for the business. You use one for your personal. I have two, and why is that? Because I love Mission Federal Credit Union. I use them almost all the time. But if I go abroad and use the credit card, they charge a foreign transaction fee, which is pure garbage. It's only 1%. Some of the banks charge 3%. But it's still pure garbage. They don't have to do it, but they do it just because they can. There's a couple of banks. One of them is Capital One, that advertises, and indeed, you have a credit card through them, you don't get charged any foreign transaction fees. So there maybe you want one for travel, one for use around town. Now let's turn our attention to home equity loans. Now we want you to get out the interest calculation worksheet, or you can just do it on a piece of paper, because we're going to go through a couple of different situations of home equity line of credit, okay? Because this is an important tool for homeowners. Again, it's a useful tool, but it could turn around and bite you. And it can bite you a whole lot worse than credit cards. The home equity line of credit, sometimes called a HELOC. You'll hear people say HELOC. It's a second trust deed. It's a second mortgage, huh? Well, you already have your first mortgage. That's the one you use to buy the home. And then once your home has more equity in it, prices have gone up, or you've paid down the loan, you can tap into the value of the loan. It's based on the current market value of your home less the amount still owed on the mortgage. So remember, assets minus liability equals equity. We usually say assets equals liability plus equity. But we don't say that. The accountants say it. We say assets minus liability equals equity, or net worth. That's where the term comes from, home equity line of credit. It's going to be a lot cheaper than a credit card, and it used to be tax deductible. Thank you very much, Republicans. But no longer. Now, danger. I love the word in Spanish, peligro. Doesn't it sound dangerous? Peligro. Yeah. Don't pay your credit cards. You can destroy your credit rating. It's not good. It's not the end of the world. But if you don't pay your home equity line of credit, you can lose your home. And that is a big deal, apart from also destroying your credit. So these things are meant to be used judiciously. I love that word, judiciously. Say it. It sounds so it feels so good when you say judiciously. Okay, here's an example. So these numbers are for, I don't know, Kansas, not San Diego. Maybe if it's a doghouse. Home is currently worth $200,000. You still owe $150,000 in the mortgage. So the home equity is $50,000. You see, $200,000 asset fair market value, what a reasonable buyer would pay for the home, minus $150,000, what I still owe on the home, the mortgage, gives us $50,000 of home equity. So a reputable lender would let you borrow 75 or 80% or maybe even 90% of the current value of your home. Some of them are as low as 70%, but 70 to 80% is good. 90% is a little getting there. I wouldn't want to do that. So 80% of 200,000 is 160,000, and we do this on the board in the face-to-face class. You want to do it on a piece of paper. Make sure you can do it because it's gonna be on and it's going to be one of the problems in the assignment, and it's also in the interest calculation worksheet. So you have 160,000 worth of eligible equity. 80% of 200,000. So 160 of what they would allow you to borrow, minus what you already owe, because you're not going to let you borrow that again, gives us a $10,000 home equity line of credit. And now you don't have to use it. You can hang on to it and use it. Maybe the furnace kicks out, the air conditioning has to be replaced, or you need to replace the roof or whatever. So that's what the home equity line of credit is for. But what you have to be careful for is that some unscrupulous lenders will let you borrow more than the available equity in your home. Oh, have you seen or heard these ads? You don't see them too much anymore, but they're still around. They were around in the big boom time of the 2000s. Get a 125% home equity loan. Consolidate your car loans and credit card payments into one easy monthly payment. Whoopee! Run up your credit card bills all over again and lose your house to us when we foreclose. You see, they don't put these two in the advertisement, do they? But this is where you have to be careful, because if you get out a 125% home equity loan, that means you can wind up owing more than the house is worth. Let's take a look at how that works. Same example, $200,000 home, $150,000 mortgage, $50,000 worth of a home equity line, home equity credit, home equity in the house, and $125,000 of $200,000 is $250,000. So they take that maximum $250,000 minus the current mortgage, or $100,000 of credit. If you went out and bought a new car at $50,000, only half of your line of credit, you would now owe more than the house is worth. If you got into financial trouble, you'd be tempted to simply walk away from your home. And this is what happened in the Great Recession, in the horrible run-up of prices in the mid-2000s, and the easy credit that was given to people if they were breathing. Yeah, if you could fog a mirror, yes, you could get a loan. It's a lot harder now, thankfully, as it should be, because we don't want to give loans to people for whom they're not going to be able to pay, possibly. So there's always a give and take. Some people are in the cusp, but in general, these 125% home equity loans, to my mind, are deadly. So make sure you can do those two problems, because they're going to be on the assignment, but they're also very important for you to understand. And you might hear the bank officers and the credit loan officers call it loan to value. Loan to value, 70%, 80%, 125% loan to value. It means the same thing. Okay, where do we get our credit? What are some of the sources of consumer credit? Well, some people say you should talk to your family. I don't think it's a good idea, folks. Except for a down payment on a home. And we'll discuss that later on when we get to chapter 7. It's called equity sharing, which is actually a pretty cool concept. Loans based on assets such as savings accounts are called secured loans, and these should have a lower interest rate, lower than an unsecured loan, all other things being equal, and they never are. And we'll discuss secured loans in the next chapter. And that's why we want to have a secured credit card. It's very, very cool, and it helps us build our credit, which is something that we need to do in this modern society. Commercial banks, credit unions, and then car dealerships, appliance dealerships, credit cards, cash advances. You see, car dealerships, this is a little dirty little secret. They make money off the loan that they get you. They want to get you the loan through them. If you go to the credit union first, wait till we get the cars, you'll usually do a whole lot better. Now they might have the car dealership might have some other deal. If you finance through them, they'll take $1,000 off. Okay, whatever. Pencil it out, work it out, but just be careful. Now, here's the idea of the secured credit and the unsecured credit. Secured credit means there's some kind of collateral. There's something backing the loan, like an automobile or a home or maybe furniture. Unsecured credit is credit that's not secured by any individual items. And this is what credit cards are. Most other forms of consumer credit are unsecured. And so if you don't have any credit whatsoever, it's going to be hard to get a credit card because the benevolent machine doesn't know if you're going to make your payments or not. Whereas we're going to see if we get a secured credit card, then they have something backing that credit card, and the credit unions and the banks are more likely to start you off slowly, paying, as I say, $30 a month for whatever, and then paying it off every single month. And very quickly, your credit score will rise swiftly. Now, here it is, the secured credit card. We're going to talk about it right now. I'm sorry. I thought it was next presentation. I'm getting confused. Secured credit card is an excellent way to begin building your credit. Go to your credit union with $300, $450, $500 in your pocket. You deposit it into a savings account and receive a credit card with a limit of $500. Now that savings account is locked. It's secured. It's the asset that secures your credit card. So now you have a limit of $500. Why? Because they know if you don't pay, they take it out of your savings account automatically. But don't do that. Use the credit card, remembering to pay off the balance each month, set up an automatic payment, and make sure the issuer reports your credit usage. Now, any reputable bank or credit union is going to do this. They're going to automatically talk to the three super bureaus, as they're called, Equifax, Experian, and TransUnion. And your credits, after a year, your credit score will rise up to the point where you'll start getting unsolicited, unsecured credit card offers. They'll come in the mail. Why? Because these people are brilliant. They know they need to find new hosts. A good parasite needs to find new hosts to infect and suck their blood. So very quickly they'll realize, oh, here's a lovely little robot that we can suck their blood, and they'll see that you're making your payments every month. And then you go back to the credit union and say, see, I done good. I made my payments. Can I close the secured credit card and reopen it as an unsecured credit card? And then you get your $500 back. That's a great way to build credit, because credit cards can destroy people. They have, Hopefully some people will come forward. Not hopefully, I mean, we don't hope that. But often in the class and in the discussion forum, you'll have some people say, yeah, they bit me big time. Okay, measuring your credit capacities. Now, these next slides are very important for you when you're doing your assignment. So please don't blow them off. Hey, I know some people say, you should break up your lecture into 5-10 minute. No. I'm going to do the lecture the way I do it in class because we have an hour or so and we break things up with calculations and the like. But you have the power to pause, speed up, go back and rewind, and you don't have to do them in the whole 40 minutes or hour, however long it takes, 30 minutes. Before you take out a loan, ask yourself, can you afford the loan? What do you plan to give up in order to make the payments? Remember opportunity costs. Set that as a goal. We want you to look closely at your debt payments to income ratio and your debt to equity ratio. Or better yet, make love, not loans. Debt payments to income ratio. Now, this one's very important. Slides 30 and 31. We want you to study these. You take your monthly payments divided by your monthly after-tax income. Now, it doesn't include housing. It doesn't include a mortgage. If you have a mortgage, that's a whole different world, and we'll get to that in Chapter 7. But the recommendation that this should be less than 20%, I think this is way too high. I think it should be 3 or 4 or 5% at the most. But hey, the industry says 20%, so I'll report what they say. I don't believe them. So here's an example. Somebody with a gross monthly income, maybe they live in Wisconsin, I don't know, $1,500. Their taxes, their Social Security, their monthly IRA contribution are these three, and the monthly net income. So we use the net income after the taxes, after Social Security, Medicare, and any retirement contributions. So that's the number there we use. Now, the installment payments. Only use debt payments. Don't put your phone. No, don't put your insurance payments or other payments, even though you have to make them every month. They're not debt payments, and you could stop paying your cell phone. Right? You wouldn't want to do that because you wouldn't have a cell phone anymore. But it's not mandatory. What we want here are the debt payments that must be paid. So we got the Visa, MasterCard, Disaster Card, Auto Loan, and that's $213. And this person is at a very critical point. They have $213 worth of debt payments and only $1,068 of monthly net income, and they're bumping up against that 20% number. And even though they live in Wisconsin and they only pay $500 a month in rent, it's still not good. So you're going to do this for you. And there's going to be a problem on the worksheet and a problem on the assignment that's like this. But you also want to do it for you. That's why you did that cash flow statement. So pull out that cash flow statement and do this for you, and then do it for your friends, family, and coworkers, and you'll look like a genius, and they'll say, you are the financial guru, and you are. You're going to be by the end of this semester, I promise. Stick with us. Now, the next one is not as important for day-to-day operations, but it's still an important number, and that's your debt to equity. You take your total liabilities. Again, you don't include any home value or mortgage. That's a whole other world. And you divide that by your net worth. So you're going to need your balance sheet, your net worth statement for this puppy. Again, less than 100%? No, 30%, 20%, if my humble opinion. But businesses try to keep it down below 50%. Although some businesses have huge amounts of debt and they don't care. That's how they operate. So here's another example, slide 33. Automobile, furniture, computer, miscellaneous, $12,000 worth of assets, equity. And then our liabilities are the auto loan, the Monster Card, the Disaster Card, American Excuse. 13. We have more debt than we do assets. So it's called debt to some people call it debt to assets, but in this case, it's debt to equity ratio. This person has more than 100,000, and this is not atypical for people just starting out. Why? Student loans. They're crushing people. Student loans are crushing people. So if you're in this situation, don't fret. Don't give up. Work to bring down that debt and get those get this cash flow statement out, get some goals written, and work to change your debt to equity ratio. but don't kill yourself, okay? All right. And then the last slide for today is, would you co-sign for me? Someday, one of your friends, family members are going to come up to you and say, the bank won't give me a loan. They said they'd give me a loan if I got a co-signer. Would you co-sign for me? Before co-signing a loan, consider if the person does not pay, you will have to. Can you afford to pay if the person doesn't? It will affect your credit report as well as theirs. You can say, send me the bills also. I want to see to make sure that this this friend of mine is making the payments. And surprise, 3 out of 4 co-signers end up paying. So now, the correct answer, by the way, to the above question is no. So you can practice it. It's a very important word. You can say it fast. No. Nope. End of discussion. Or you can, what I like to do is draw it out. No. So would you co-sign for me? Right. No, that's the right answer. Okay. So when we come back, we will discuss credit ratings and the super bureaus, and then what happens when things go bad, bankruptcy. So, dear students, have we scared you enough? Have we warned you about the dangers of evil? Yeah, okay. Yeah. See you in our next presentation on consumer credit.